Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bobby Iaccino. Together, we are also co-authors of unfilteredinvestor.com. Please go to that site and check us out. Bobby, again, with some strength in the equity markets today. What's happening? I thought Bobby and I talked for a second, and then we bring on the guest. I'm seeing, Bobby, do you see different pictures or no?
Mike, I'm seeing all kinds of goofy things on the stream.
There we go.
I'm seeing multiple screens, but I don't care that much.
I don't care that much. It's more about the words anyway. People don't tune into our show to look at our good looks. Maybe they do Mike McGlone's, but we'll bring him in a second. So we're going up against that 7,000 high in the S&P. We've tickled it about 5 different times in 4 months. Is that the put up or shut up level? We need a real reason to get above it or what?
Yeah, I think really people are way too focused on the Fed. I mean, when you look at the Atlanta Fed GDP now, it's not Atlanta Fed, is it? Yeah, it's Atlanta Fed. Yeah. Their GDP now is up over 4%. Data's starting to come in. I'd call it mildly stronger. So I think people are way too focused on what the Fed is going to do. And I think it's an issue with that being the case as to whether earnings have been strong, but based off of a lowered bar. So, yeah, I think we need a reason. But the reason I think we need is for either AI to bounce back or people to believe that the rotation is a good thing.
Okay, and I think the rotation is a good thing, but it doesn't have to be a good thing on the short term. You know what I mean? It can be inelegant, it can be clumsy. But I will say, and I want to bring Mike in for this too, but remind me that this is a topic I want to talk about, is the fact that, yeah, the BLS numbers looked relatively blockbuster, but nobody believes them. People call Wall Street on them, particularly when JOLTS and ADP were directly in conflict of that. But anyway, you people who are watching, you know what I'm going to say. I say it every time, is you may have watched Bobby and I for the last 25 years and think we are full shit, but you cannot deny that we get outstanding guests. We don't know why they say yes, but they do say yes. We have senior commodity strategist of Bloomberg Intelligence, Mike McGlone. Let's bring him on. There it is. Where's the drums and everything? Something's up with our.
Who's there, dude?
I did not hear the drums.
Yeah, I heard them, but like the screen is weird. I don't know why, but it's not weird on the stream. I'm looking at it right now.
So, Mike McGlone, do you if we took Michael Jordan at his prime, beamed him into this is important, Bobby, beamed him into 2026 NBA, which I barely ever watched, would he still dominate the way he did, or are these players physically more advanced?
I just love these hypothetical questions. It's not fair to do that unless I have a beer in my hand, and I've had a few because it's more fun.
But I already had a few. No, I'm just kidding.
It's very relevant. First of all, thanks for having me on. Beyond with guys like you traders, we used to knock around the pits together. It's just, we can add a lot of value to our audience, and I'm honored to be on with you. And one thing I want to mention lately, I think it was today, Scottie Pippen was all the tape pointing out a wedge pattern in Bitcoin. And it just brought back memories. You might remember, I remember being in the trading pits in Chicago and messing with the New Yorkers, and it was always Michael Jordan kicking Patrick Ewing's butt. They just loved that. It was fine. The second city, we kicked those New Yorkers' butts. So that series was awesome.
Yep, sure was. I loved it. I loved it. Even when Jordan was gone for those 2 years, we were this close to knocking the Knicks out. There was a fabulous series without Jordan. A lot of people forget that. And then Houston won the championship that year, but it was quite amazing. What a time to be a Chicagoan. It was like literally, I try to explain it to the younger generation. Like my wife and I just started dating, and she's a huge basketball fan. We'd plan our entire social schedule around when the Bulls were playing, not in the playoffs, just on a normal Tuesday night in late November. Yeah, it was crazy. Bobby?
Yeah, I think Jordan would average about 120 points a game. 120 era. Yeah. I just, all kidding aside, I think it's funny when younger people say, well, he was a bad 3-point shooter, as if Michael Jordan, knowing the 3-point line was the most important thing, would not have become a master of the 3-point line, just like he did everything else. When he was bad at something, he worked on it, and he was the best in the league the next year. Also, I did something interesting today, Jimmy. I don't know if you looked at it, and we'll get into markets, I swear to God. I took all of Michael Jordan's and ones. Okay, so when he drove, scored, got fouled, and made the free throw, and if you add those plus the misses where it was only 2 points, right? He was a 46% 3-point shooter if you count those 3-point and ones as 3-pointers. Right. So he actually ended up getting 3 points 46.6% of the time, which was 0.2% better than Steph Curry last year.
Huh. I'll take it. And Steph Curry's not exactly take it to the basket, get fouled, hit the N1, which, by the way, I will add one more thing about Jordan. And yeah, but Mike, I've coached basketball for 30 years. I consider myself like a guru. And when I read that the Bulls picked Jordan, I was like, crap, another slasher who can't shoot. Wow. He's like, I wish they would have gotten, what was the guy's name who went to Portland? Sam Bowie. I was like, Bowie would have been so much better. So I admit that. And the first time I watched him play, I was like, huh. Maybe I don't know this game.
What you just did, Jim, I think makes you an exceptional trader. First thing you got to do is admit you're wrong, stop yourself out and move on. But remember, every time, Jordan got overcovered, he'd just pop it over to Pax, and Pax would hit the 3-pointers. I mean, it always worked. He just figured out a way to run it.
Figured out a way, exactly. Okay, so we have to get, I guess, right into Bitcoin. For you guys who watch this show, know that there's been, some Twitter animosity, whatever, some arguments going on, which, by the way, we do not shy away from arguments. And I like and respect both parties to this argument. And we are talking about Bitcoin, and Bitcoin got the absolute hell beaten out of it over the last, call it whatever, that made 126 high in September, October, and then got killed in the same time period. Silver lost 47%, not the same time period. Silver made its high on January 29th. The NASDAQ put in its highs and traded lower. Is this just a blow off the steam, trim the hedges in Bitcoin, or do you think this is put the fork in it?
Well, I want to know your views on that too, but I think this is the whole Atlas asset class is dead and imploding, very similar to a dot-com bubble in 2000, 2001, 2002. It's only 2000 the way I see it. And partly because, first of all, it's lost the big mojo. The key thing I loved about writing about, I just published on the terminal. And I remember my goal is, this is a show and tell part of my job. My job is to write to the top financial professionals on the planet in Bloomberg terminals. And I love writing when we had Trump 1.0, that the space is its base layer is the dollar, and the most enduring trend was crypto dollars going up, and you got away from the system, and it was and we're going to get ETFs, and sometime our government's going to figure that out. That was all the stuff to look forward to. We got all that in 2024 with the election of President Trump, and now we're in the implosion mode. The question is how much further it goes, but I think we're clearly in that stage. It's in the liquidation market. We'd get lucky, and I look at it as just a bear market. So I think what we're going to be is, to put this in trading terms, I think it's going to be a sell on the opening year when Bitcoin peaked around just above 90 in the opening. It's going to be a buy in the close kind of year.
Okay, interesting. Okay, that's good. Bobby?
In December, I think it was December, I spoke at a Bitcoin conference, and our friend Mike here was on the panel that I spoke at. Was that December, Mike? Or was it earlier than that?
It was in Naples. I can tell some stories about that one.
It was here in Naples, Florida. And Mike was one of the only people, including myself, by the way, who was on the panel as a skeptic, who was willing to say that Bitcoin would go down by at least 20%. And he actually put a price tag on it. Do you remember the price?
Yeah,
Mike.
I remember clearly.
67,000
initially, but I'm going to own this one or wear it, and I'm just, when it got above 100,000, it's going to drop to 0, which means 10.
Yeah. So basically, he said this, right? And I think when you talk about some of the animosity and arguments, I heard there's one out there. I didn't see it myself. When you talk about that, I think there's a sensitivity, and this is one of the things that bothers me about Bitcoin as an asset. I don't get upset. I bought the IWM recently, right? The Russell 2000 ETF, and I was getting beat up on it. And when people said, why aren't you out of it yet? But my answer was, it didn't hit my stop. Not, you guys just don't know, people. I'm just going to keep buying it here. Like, Bitcoin people don't acquiesce to a trend. They say the trend is wrong and we need to buy more. And if you're talking to someone who is a Bitcoin maximalist, let's say, if you're talking to someone like that during a downtrend, they're edgy. They're touchy about it. And that's the thing that bothers me about the asset. It's the people that support the asset, because anybody who truly supports Bitcoin and doesn't really rely on the appreciation should not be feeling sensitive right now. They should be feeling exalted at the opportunity they're getting on the lower prices. So, Mike, where am I wrong?
No, that's the difference. Remember in the trading pits, the joke we used to use for people who were being irresponsible about life, you'd say, oh, he's trading without stops. Because we came from, I always love when people say, oh, never use leverage. When you start in the trading pits, you're born and raised with leverage. I mean, typically it's 20-1 in a typical futures contract, maybe 10-1. And you always have to define where you want to get in or out, where you're right or wrong. And you use stops or use some form of mitigation risk with options. And that's why I look at it. So at the beginning of the year, I thought, okay, you got a short here, prove me wrong. And so far, this first move back to 64 is the first place you're supposed to cover shorts. But that's the key thing that's so important that you mentioned, Bob, and that is when people get too emotional about numbers on a screen, you know there's something wrong. I'm guilty sometimes too. I have to force myself not to be, but that's when I look at it as a stoic and say, okay, what's the opportunity here? And right now it's a bear market. Unless you're stuck overweight long listening to someone on the sell side who said you're supposed to be long this risk asset class, there's unlimited supply. I know Bitcoin doesn't, but all it's got tons, it's got millions of competitors. Then you have to be careful, just trade it. And it's a great trading vehicle. I just look at this year's, okay, bottom at 60 or so. Maybe it'll give you a chance to sell above 70, but trade it. It's great trading opportunities, but you got to have stops.
So what's crazy to me is that I've said for this whole time is that I believe that in 10 years time, Bitcoin is more likely zero than it is a million. And I've been involved in case I'm wrong. And I still think there's a greater than zero chance that it is the thing, whatever that even means. But the emotion that's tied to it is crazy to me. Like this Michael Saylor fellow, I don't know him. I don't mean to disparage him. I know you guys met him. He was at that conference, right? But the people who follow him with his absoluteness, and then they think they have to get into a highly leveraged product of one of the most volatile assets on the planet anyway, to me, it seems like a fool and his money are soon to part. What part am I missing there, Mike?
Well, I tell you a quick Michael Saylor story. In 2022, I was lucky enough in Miami. Bloomberg says, okay, we're going to have our first conference with people. You know, it was after COVID. We want it to be Miami. Mike, we want you to interview some people. Pick whoever you want. I chose Michael. And it was a great interview. It was just me and him. It was really easy. I just shut up, got away, let him run. And most people in the audience said, I'd never heard that take on Bitcoin. Now, I was very bullish. And that was right after bottom run 10,000. I was really bullish, but it was very lonely. And that's the way you want to be, being bullish Bitcoin or anything. You want to be lonely. When you feel comfort, something's wrong. Okay, you got a 10x. And then at the end of 2024, he doubled down. He made fun of Warren Buffett. He added to his long. I mean, the lessons we learn in trading pits is when the market gives you that much money, if you don't give a little bit back to the market gods will punish you. Now, he learned that lesson. MicroStrategy is down 70%. But so he's been a great indicator for me for long or short. And I'll end with one thing. You know, you mentioned that conference in December. Well, we had another economic club event late at the end of the year in December. His quote was, we buy Bitcoin with money we can't afford to lose. I put that in a headline on X and LinkedIn. I put on, this is why it's going to 10,000. I got the most hits on that one ever. And that's just the key, the hubris of that statement. I'm like, good luck. I buy treasuries with money I can't afford to lose, but I guess I'm old school.
How about gold?
Yeah, that's great. I said to in a Bitcoin podcast I did, and I don't really want to purely beat up Bitcoin here, but on a Bitcoin podcast, I said to him, the guy's name is Matty Ice, really, really nice guy. He's at a lot of these conferences too. Mike, you might have met him. And I said to him, I go, the problem I have with you guys is you don't think it can go to zero. And he goes, it can't. And I said, it can. Everything can go to zero, literally everything, including treasuries. He goes, well, it can't go to zero because I have huge bids at $5. Like, well, those are going to go to zero. That's just my point. So there's just sort of a friend of mine said to me years ago that Bitcoin needs an adult in the room. And I thought that the adults arrived. But anytime you see these declines in price, you see a lot of the people you consider to be the adults in the Bitcoin room act a little childish. Not trying to disparage any individual, nor the person you were speaking to, Mike, on that podcast. I haven't watched that episode. Actually, he's supposed to come on a show of ours in a couple of weeks, so we'll talk to him about it. So the decline we've seen in silver and gold, what do you make of that? Now, my stance, I'm going to give you my stance on gold. Silver, I lose money every damn time, so I don't touch it. But Jimmy's in silver. He's in silver and gold and copper. Now, I have been in gold for a long time. I sold some finally, some of the longer term holdings. But I'm thinking of buying those back, if I'm being honest. So what do you think of the gold story? And the reason I say that is because I don't see a fundamental way that it drops substantially.
Well, I don't know if I'm allowed to share screen. If I can, that would be great. But in the meantime, I'll just talk about what I'm thinking here, and that is, I've been beating on a horse for a while, and I'm going to warn you about a headline that can come out tomorrow. It might be time. Is it time to sell gold and buy T-bonds? And this is the reason I say that. If you look at a basket of U.S. Treasuries, we have an index going back to 1973. That's the whole curve. If you're invested in treasuries, you divide by gold, we're the lowest in 44 years. So gold is most expensive versus the broad U.S. Treasury market in 44 years. At the same time, I show Bitcoin potentially rolling over. To me, that's just the start. This will be the second consecutive down year in a row.
You said Bitcoin, you meant gold, correct?
I'm pointing out. So this is treasuries versus gold. So my point is,
I apologize.
Yeah.
Thank you.
And I'm leaning over to the point is, I think Bitcoin going down is going to be the trigger. So when you see something like this that's that low, you can't do the opposite. You just have to wait for an opportunity to jump in. You don't want to, as they say, catch the falling knife, but I think it's going to turn. I think the treasury market's going to turn upwards in terms of price, downwards in yield, as gold rolls over when Bitcoin does. And Bitcoin's starting to roll over. But the main reason is if you overlay Bitcoin with the S&P 500 divided by GDP, this is a Warren Buffett model. It's the highest since 1928 on an annual basis. My point is just a little reversion in this from the highest level in almost 200 years means the trade is to be selling gold and buying T-bonds. So that's my job, is sometimes to make the call. I'm making the call. And I've been bullish gold for decades. I've been writing about it. In fact, my colleague Paul Sweeney, every time I get on TV with him, he always makes fun of me. As Mike always said when he first came here, but when he asked me about commodities, I said, well, just buy gold. Everything else fluctuates. Gold goes up. But now we're past the point where it's the most expensive ever versus the Bloomberg Broad Commodity Index. It reached the 60, the highest ever versus a 60-month moving average since the peak in 1980. That high at 850 lasted until 2008. I was long back then because you had to buy on the dip. But the point is, now that the masses are in, the whole metals market, including silver, copper, feels very much to me like cryptos did a year ago. And I just look at it as I switch over to a risk manager and say, nope, this is the time you're supposed to take that risk and say, get out. And I think everything, particularly every metal, gold may be on the lower end, but certainly copper and all industrial metals is going to be completely subject to whatever the S&P 500 does next. So my point is, if you're long any risk assets, which means every metal and even gold now, because it's so elevated, you have to be hoping that stock market goes up. And that's my base case. Is volatility is way too low. 180-day volatility in the S&P 500 is the lowest in 8 years. You've got to hope that stays lower, and that can happen. But my point is, walking in the year, it's going to go up, and I think it's going to flip the switch where we get just the next 10% drawdown the S&P 500, and I think you're going to see things like TLT, if it stays down, go up 20%, and gold drop to 4,000. I'm pretty confident. I still use silver above 100 as my prudent short list because it's got a proof strength above that level, and go back to 50. And then at this point, you hear all the fundamental stories, and these are things that, people like me were really bullish gold in 21, 22, 23, and I was wrong, calling for it to go above 2,000. But that was a pain. Now the gain is so extreme, I say just get out or lighten up and overweight, risk off assets. And before, so I'll end with this. At the end of 2024, I had switched. I officially flipped away from Bitcoin. I said, no, it's overdone. It was too early, and I flipped to gold. I was shocked that I had the best year since 1979 in gold. I mean, that was off any value at risk model. And when you get that and you're on top of that trade, you don't double down. You say thank you, take profits. And that's the way I look at it now.
Well said about that. Say thank you and you take your profits. Leave if you think it's going to the moon, you leave a little bit of a position and forget about it, but not enough to ruin your whole trade. So when I hear you say this about the metals complex, am I wrong in reading in? Because what I see is this: one of my fundamental cases, and I think your fundamental case is just the price is already everything's priced in, but M2 money supply still is going higher. The Fed's balance sheet is now going higher as they're back in doing not QE, buying short end notes, right? So the Fed is injecting more money in the system. M2 money supply grows.
Not QE, I love that.
What the hell is it? They're like, oh no, this isn't QE. Just look, keep an eye on the hand. Don't watch where you're taking money out of your pocket. But anyway,
this is literally called not QE. And just so you know, Mike, your charts are still on the screen, so let us know when you want them down.
I want to talk about this one next.
Yeah. But anyway, so are you saying that doesn't concern you, that we're still spending money like drunken sailors?
Well, it does, but let's look at the facts. next largest economy on the planet, China. Their 10-year note yield is 1.79. Their debt to GDP is 300% that we know of. Goldman Sachs has estimated that. And their money supply is running double what the U.S. is, almost $50 trillion. They're doing exactly what Japan did in the 90s. They're fighting a severe deflationary force after going up too much and going back down. That's mostly housing. That's what potentially is going to happen in our country. The bottom line for me is those are known knowns. We all get it. And it's the key thing we all learn is when everybody says the same thing, we got to be careful. The problem is when you have a supply-demand model, you have supply-demand and you have price. When price shifts this exponentially, it shifts that supply-demand model. And every time in history, it usually ends with things going back down. It's just a question of when. And to me, that's what's happened in the market is people are using the past narrative to jump on a trade that's already run, and you never want to buy autocorrelated assets after they go up. Number one, that's silver. The least autocorrelated is gold, but I want to show you one reason I'm still buying on that, and that's what I'm showing this chart is this is a shot of retail sales minus CPI. It is negative. Not only so important, but it's running negative. It's a 12-month number. I've been using this for a year. I've been wrong because it went above here. The last time it really tilted negative was major. We've had pretty severe recessions. The bottom line, though, is we're getting retail sales dropping below CPI on an annual basis with the stock market cap to GDP, the highest, the wealth effect, the highest in over 100 years. So my point is, if you can't get CPI lower with this kind of wealth effect, what's going to take? So here's my point I'm going to make right here is CPI is, I think, just our retail sales, it's going to drop to negative, and even CPI will drop to, which is 3% now, drops to zero because it has, like similar to this chart, 3 times since 2008, when we just get a little reversion in the stock market. And that's my base case is everything we talk about, all the data we see on the screen is all down to a 5 or lower when you watch the stock market. It's that next 10% move that matters for everything. If it's up in the stock market, then maybe things like silver can stay up above 100, maybe copper can stay above 6, maybe Bitcoin can recover, but if it drops 10%, dominoes tumble.
So you don't see, if that 10% drop comes, you don't see anybody rushing into those typical safety assets. You see them all going into treasuries. Is that what I'm reading correctly?
What I think is, it's not an if, it's a when. Okay. From what level? So we can drop, we can rally another 50%. It's a when, and then we know it's a when, then it's going to drop 20% and stay down. That's going to happen. It always will. It's going to probably, at least for a little while during the next 3 years of the Trump administration, who's he going to blame? But my point is, I see a normal post-inflation deflation cycle. Like I said, it's happening in China right now. Once you pump the system liquidity, most notably after risk assets go down to try to save it. And the bottom line is, when you look at markets and even look at the data, yeah, thanks. And if I'm sitting long copper, I have to hope this U.S. stock market goes up because it's an overwhelming force now. And to me, as far as money flows, it's just a severe deflationary force. So I didn't have the chart here, but CPI has dropped to 0 3 times since 2008. And every time that's when crude oil bottomed, they're 40. And I point out now it's hovering at 2.4 despite this massive wealth effect. Now this, I'm talking about CPI now. Here I just show retail sales. The key point is it's probably going to drop to 0 the next time we have a little backup. You have to have this wealth creation machine keep going from the highest levels ever, yet we've probably reached a peak. So what's happening? We've had earnings crushing it, yet prices are peaking. It's towards the end game. And even what came out in the minutes today, the Fed was pointing out they're worried about inflation. That's most of the governors. And we all know you're not supposed to be adding fuel to the punch bowl when the party's getting out of hand. And good news is Bitcoin and cryptos are showing the party starting to alleviate a little bit. But I think the bottom line for the Fed and everything right now is we're going to get a decent amount of interest rate cuts, not 25 basis points, but 50 or 100 when the stock market goes down and stays down. And let's think about here, we got the midterms coming up. Here's a unique thing is Mr. Trump is probably going to get lower crude oil once he gets things done with Iran soon. He's probably getting lower natural gas. He'll get lower energy. But to get lower interest rates and yields, there's one simple little thing. If you just get a little backup in that stock market, the Fed will cut easy, cut fast, and I can easily see 100 basis points drop in long bonds and in mortgage rates.
Bobby, can I interject something that I want you guys to comment on real quick? So in December of 2020, this, by the way, it's along the way back machine. I'm not going to tell them when I got my first red wagon, but this is kind of scary to me. It was actually my clients started putting on enormous upside in SOFR products, for lower rates. Like really, like every day, people like, what in the hell is going on? Stuff that was unheard of. And then a couple months later, boom, every one of those trades exploded into profitability. I'm not trying to be any sort of conspiracy theorist here right now, but again, if you've done this as long as we have, you start to think somebody always knows. I don't know if they know what was going to happen in early 2020. So I'm saying December 2019 is when all the upside was put on. A couple months later was COVID. We're seeing similar things like that in the last couple of weeks. Have you seen the order flow in SOFR options of enormous upside being put in? Something that I haven't seen in 6 years. Did you guys see that at all or no?
I didn't see it.
I haven't, but you remind me of a big trade in 1998. I remember seeing those back month euros. Jim used to be in that pit, and you just look at the back months. The Fed was not doing much, but the back month euros kept inching higher. I'm talking the 5th and the 6th, and I kept trying to say, guys, we'll just buy some out of the money calls. I remember doing that for a few months, and they expired, and something's going on here. I don't know why, but they keep inching up, back month euros. And then long-term capital imploded, and some of my clients made 20Xs, and that was one of those trades. Sometimes I didn't know why, but market was telling me something. To me, that's what it's telling me right now. By gold taking off and silver taking off and potentially putting in pretty high peaks and crypto's collapsing, the market's telling me it's just a matter of time. The next trade is deflation, and then you want T-bonds. So
Bobby, it's your question, but in response to seeing those SOFR trades, I increased my hedges in the S&P and in the NASDAQ to like 3 times what I normally have on, because it's starting to scare the shit out of me. But let's quick break for a commercial. Luis, can you put the banner up? And then Bobby, I swear I'll stop talking for a while. You guys are give us so much support on this, and I appreciate it very much. One favor to ask you, please scan that code and try Tradier Pro for 3 months for free. We talked to guys who've been trading options for decades, and some who've just been trading them for days, and they all say the same thing about Tradier Pro. It is the absolute gold standard in options trading platforms. Please do us a favor and try it 3 months for free. And now back to the show.
All right, so let me ask you then. I think there's going to be a spike in consumer discretionary spending. And the reason I say that is because, save for the depreciation acceleration that companies are getting starting this year, but I think I'm hearing anecdotally about really large tax returns that people are getting. And I'm also hearing about the excitement for no tax on tips and no tax on overtime. Now, overtime is actually starting to ramp up if you look at the data, in part probably due to deportations, I'm guessing. Right. I was looking at a story the other day about a South Carolina home builder who is just way behind on building, and they're running their people on overtime, and that overtime pay comes with no taxes. So I'm curious as to whether either one of you think that the inevitable drop that I think the three of us agree on could be pushed past the midterms due to fiscal factors like that. Mike, you first.
Yes. Definitely. The key thing, I think, for midterms, what's the number one issue is affordability and inflation. Those factors, I think, are important. They're just such known knowns. We've known about them for a year. I've heard people say about it when they talk bullish stocks for about a year at conferences and everything. It's just a pretty much factored in thing. So agreed. It's a wonderful thing. If there's anything, then when Trump came out, I'm like, yeah, I mean, that's, we've all been there, and we all have a lot of family members who work in those kind of areas. And for us, we're kind of rich white guys. It doesn't matter for us, but that is so important. But to me, the bottom line is what I'm worried about as we get to the midterms is I think he's going to get lower energy. I think he's going to get the average gasoline price in this country, which is around $2.90 towards $2. He's probably going to get natural gas lower. Certainly crude oil, I think, is going to be closer to 40 than it is now. But are those kind of things going to be inflationary? Probably not. They're going to help his constituents. I just don't know how much it's going to make. He is just buried in the polls right now. So I'll make a prediction. By this time next year, we're going to be using his name and lame duck in the same sentence. And it's going to be very different to see how his personality, his mercurial personality reacts to that, particularly when we get the next 20% correction in the stock market. He can't blame Biden. And that's my point. It's a lose-lose now. It's got to go up. It's such a negative thing. My point is stay away. That stuff's all good, but the bottom line is it going to keep the stock market bid? And all you need sometimes is a little switch to the sentiment, which happened in cryptos in October 10th, and that's the end game. That's all that matters. So
Bobby, see what you think, Jim. Question: I extended my duration on my put protection. It's pretty substantial right now. It probably takes away about a third of my exposure to in all of my equity holdings, even for investment accounts. And I have those extended out through June. I do think something smells a little bit funny right now. And again, I'm probably basing it on what I've seen in those interest rate markets, but I do up till this week, my base case was that from an economic standpoint, there was tailwinds, not headwinds more, with deregulation, no tax on tips, the expensing, the business expensing, I thought was a huge deal too. And if investment is really coming to our shores, I know Donald Trump says it's 21 trillion, which if you do the Donald Trump deflator and it's only 7 trillion, that's still significant, right? So I think that there was things that were lining up behind it. But again, we're trying to pass the torch off from a weak labor market, some crazy couple of years that we've never had a reckoning for. Prices are pretty elevated. So let's see what happens is what I'm saying.
Well, I guess, and I don't disagree with you guys. I'm trying to personally understand it because I think the midterms is really the wild card for me, as well as the SCOTUS decision on Friday. I mean, when you see the kind of press conference we saw from Sanae Takaichi, Jim.
Nice job. You nailed that.
I say that perfectly.
Takaichi. It's pretty good, though.
Yeah, she had that press conference today, and it was another promise of $70 bajillion trillion being invested in the U.S. by another foreign government that we likely will never see, because by the time it probably has start dates 10 years past Trump's second term, and no one's going to ask for the money past that point. So I think that's one of the negative parts of that. If all these countries were actually investing the money in the U.S. economy that they've promised, well, I should say that Trump has announced. I don't honestly know if it's written down somewhere and actually legally promised. Yeah. But, if we actually see those kinds of things, I have no thoughts that the market shouldn't correct and go into at least a 6-month bear market, maybe a year bear market. I think that's necessary at this point. But what I'm trying to figure out is how long can it be delayed? And if it is delayed, Mike, you talk about that deflationary cycle. 2.4%. One of our smartest viewers, he goes by Widge, third gen widget is his Twitter handle. And I haven't seen a question by him yet, so I don't know if he's watching today, but he put up a post on Twitter, and he's not one of those, 200,000 followers guys. He's just a smart guy that watches our show a lot. And he was like 2.4% is not moderate inflation. So the public still sees this as being a very inflationary environment. Now, I maintain when you have prices go up 27% and you're piling 1% to 2% on top of that, it still feels like pain, right? Yeah. So I'm wondering, does the stock market and the risk asset market, let's say, have to collapse first in order for prices to go down? Because I believe it does.
Well, I want to show you another chart on that, and I want to emphasize the book, The Price of Time by Edward Chancellor. His quote was, anytime you have big money pumps and liquidity pumps in history, you always get inflation and then deflation. I want to show you a chart. This is CPI. Let's go back to 1971. And it is just, you look at that chart. You as a trader, I'm like, I'm going to try to sell rallying that. It can't get above 3%. And it's hovering at 2.4%. So you look at this, let's forget what it is. I remember in the trading pits, we would show our kids a chart at home and say which way it's going. So they knew nothing about it. It was kind of fun. But you look at this and say, okay, if you're a trader, you kind of want to sell here and look to buy here. This is CPI 3%, and this is 0. It always goes there. It has. And there's never one little forces. I look at this as if CPI can't stay above 3% with the greatest wealth effect in 100 years, what's it going to take? So to me, this is the next big trade. But the point is the timing. So I just like to say sometimes it's better to just get out and look at it as a trader and wait for opportunities. And like Jim said, you're hedging. I don't trade. I'm not allowed to trade at Bloomberg. In fact, it was good for me. But to me, that's the key theme here is you have to have this force to keep going up, which is, like I said, 2.2 times before this to even stay elevated. That's CPI. So I fully expect within a year or two, CPI is going to go to 0. It's a normal thing. And there's one other thing, just the S&P 500 going down 10%. But that's the point is it's completely anathema to what people's expectations are. So when I was on with a bunch of metals people last week and they're all talking bullish copper, I'm like, so you expect the stock market to go up? And they looked at me like I had 3 heads. I'm like, I'm sorry, but if you have a value at risk model and you're sitting running money, which we all have, and I remember doing it, it. And my copper position's there. I better hope that S&P 500 goes up, because if it drops 10%, I fully expect copper's going to go down 20%. It's so linked now. Everything is. And Bitcoin. So I want to show you one other chart. See how this chart looks? Okay, that's going back. This is just Bitcoin back to 2023. Same kind of thing. It looks like it's going to break down below this. This is the essentially kind of the mean, and the mode is around 28,000. What stops it? And then here's the key thing: is that Nasdaq peaked right after Bitcoin October. It's got to stay up, but at some point, if that breaks, there's a trade. But so far, it's not showing any signs of that.
No, I think that's absolutely fascinating. And I agree.
Luis, can you put up its stock charts comment for Jimmy to look at before we move on to something else? This is Remo from its stock chart. January 26 inflation, 2.4%. Nominal average weekly wages grew by 4.3%. And that's the other side of this conversation, right? If wages grow enough, all of a sudden the increase in 27% increase in prices from COVID on doesn't feel as bad. All of a sudden that solves the affordability crisis of wages.
Here's a part that I'm not 100% on board with Mike, which, by the way, I don't like not being on 100% on board.
No, we need to disagree. It's important because it helps our views and our audience. It helps. Yeah.
Right. So 2.4%. You mentioned that 3% level of CPI. I've been arguing, Bobby can attest this too. I went against Jim Bianco. I hate going against Jim Bianco too, which he thought of resurgence inflation. I think we're in the midst of a hugely disruptive emergent technology that is probably going to be somewhat disinflationary. I thought we're going to have a difficult time above 3%. That's one prong of my argument. The second is that I actually think the Federal Reserve wants 2.7% CPI for the next 2 years to try to monetize some of this bullshit up to our eyeballs debt that so many government entities have. So I'm concerned when I see 2.4 that I think Warsh is going to hit the gas even further. And then what should I be in? And then it comes back to gold, silver, real estate, equities. But again, I'm not going to double up on equities until the technicals tell me to. And that's, according to Mike Arnold, a settlement above like 70.25 in the S&P and then some strength beyond that. So I'm waiting for the signal. But does my thesis of the Fed hitting the gas because they're pissed that inflation's only 2.4% make sense?
Well, we know the narrative that Warsh is going to come in and cut rates, and it's kind of silly because who did appoint Powell? And Powell looked back and pointed out to Volcker, and he realized, I don't want to go down in history as Trump's lackey, and Warsh is going to do the same thing. Is he going to risk going down in history as Trump's lackey? Let's think of what's going to happen within the next 2 years. When, I shouldn't say if, the stock market absolutely has to go up. So if it just starts dropping a little bit, Trump will be to blame. We can always say he trumped cryptos. Cryptos got trumped. They went up too much. He talked them up. I just saw his two sons on CNBC still talking them up. Oh my gosh, there's going to be laws against in his future. The president with his loyalties all getting involved in an asset, pumping it up, and then it going down. That might be somewhat illegal in the future. But I think stocks are going to get trumped because he's too much of a cheerleader, gets too people involved in taking way too much risk than they should. And we're also at that point now as any risk manager, any sell-side strategist has to be bullish. And we haven't heard the quote yet. Oh, it's a healthy correction. We haven't even got close enough to that healthy correction. We're going to hear that. But to me, it's the end game when you see what's happening in precious metals. And there's a few times in my life, I remember in 2008, I came in short and flat and just had a great trading year. It was all PA. But this year, I feel the exact same way. Come in flat and just look to trade opportunities. And that's like what you're saying, Jim, you're laying in some puts. I look at it, this is potentially the big one getting started. When you can go back to saying gold's the most expensive relative to its 60-month moving average in almost 50 years. And when silver, just a few weeks ago, reached the highest ever versus copper and crude oil, those are quotes I'm probably not going to be able to say the rest of my life. You're supposed to act and do something about it. It doesn't mean buy silver above 100. It means sell it.
So, Bobby, you want to know my trade today? I was kind of proud of my trade today. So I went out till June, and Mike, you might be interested in this too, if you are. I don't know. I sold the 685 calls to buy twice as many of the 6700 calls. I did an SPY, not futures, and then sold another 5,000 call, way lower, and the June expiry. So you have all that distance between 6,700 and 5,000. You have that put spread on, and you sell one of those 685s to kind of defray the cost a little bit, because it's for the big one. It's not for just, and again, even if there's a grind lower, those 67 puts, I said calls, I meant puts the whole time. You guys knew that.
Figure that out by the prices.
Yeah, are not the 60.
Why don't you do me a favor and repeat it for people who were a little confused, Jimmy?
Yeah, I'm sorry. Those were puts, not calls, people. So I'll repeat it one more time. I sold the 685 puts, or 6850 if you're doing it in futures, bought 2 of the 6700 or 670 SPY versus futures, and then sold another 1 of the 5000 puts, way lower. I think
you'd love to get to that strike.
Yeah, if we get to that strike, I'll take what I can.
Yeah, thank you.
38% lower. I actually may sell an additional 1 for every one of these structures I have on down there, just to be long down there. That's kind of way to play the big one, Mike, you think?
Yeah, I don't know how it's going to pan out, and I just that's why, and my simplistic way is like last year. It was easy to say, all right, just overweight gold and treasuries. And I was shocked how that position just crushed everything. I mean, gold was the best year since 1979. That was, something was wrong with that. And it was, in one of my colleagues, person at chat pointed out, oh, you said lighten up at 4,000. I'm like, gosh, that's a dream to be able to take profits at extraordinary level. But the key thing I've learned about options, you're better than I am, and we've traded them a lot, is that market, that'll go to those strikes once my options expire. After my options expire, particularly if I'm long premium. That's just the way it worked. That's how you used to have here.
But by the way, Mike, you remember when Motorola split to Solutions and Mobility?
Yeah.
And I believe that they did that to have Mobility be a takeover target. So I kept buying calls in Mobility and thought I still had them on when Google announced that they were buying Mobility, and they'd expired the week before. It would have been like a 20x trade, because I was just like, it has to be. That's why they split it all up. But Bobby, you? Yeah.
Yeah, no, I've seen a lot. I subscribe to a couple of different options services. I don't actually ever trade options. I just like to see what the options guys are thinking. And there are a lot of flies. There's a lot of flies. There's put flies. There's selling call flies. There's iron butterflies. A lot of them in these option services. Nobody is taking straight positions. And by straight positions, I mean put spreads or selling call spreads or something. Everybody has got this sort of, it might go down. It reminds me of kind of why some people own Bitcoin, including myself, in case we're wrong. Yeah. You're putting on the option trades in case it happens. There's a weird sort of in my view, there's a weird sort of a psychology that goes on with equity trading, because it's really the only asset. Mike completely disagree with me. You think I'm an idiot. It's really the only asset that has a natural upward bias. Maybe gold does. But when you look at all the long only funds that just buy stocks every single month because that's their job, it has a natural upward bias. So people, I think, have this idea that stocks are the only thing that can't go down and they can always go up. But all you got to do is go back to 1999 to 2001 to see how far stocks can go down. What did the NASDAQ go down at that point?
Well, I remember 5,000, and then it was in the teens, like 12, 13. And I could pull up the chart. I don't really want to, but
I thought it was 70%, right?
Yeah, it was
more than that.
Pretty deep,
79%.
Yeah. And it's just the classic. But the human nature is so important. Is you have to be able to identify when you sense that everybody's on one side of the boat. And that was clearly cryptos last year. But there is, we're talking options. I want to show you one trade I've been looking at and that I've been wrong on for 3 years. And we know this well, certainly us Chicago guys, is I started in this trading pit. I'm going to show you a chart on the U.S. T-bond future. The T-bond future, US 1, used to be the #1 trading pit in the planet until you guys in the Eurodollar stole all that, Jim, all that volume. I'm still mad at you for that. But I started in this pit. I don't know if you guys can share it, but whatever. But the bottom line is the Bollinger Band, the 100-week Bollinger Band and that T-bond is the narrowest since 2008. It reminds me well, because I was long bonds back then too. There's only times, but it's going to break out. There's not much room for it to go down. Maybe it goes down to 17 or so, but it's going to break out and it's going to go up a lot. It's just a question of when. And if I was buying calls on it, they probably expire worthless and then go up. But to me, this is a long gamma positive delta trade, which means calls. It's just a question of what's the spark going to be. And I won't mention this. I showed the exact same chart on the gold S&P 500 to gold ratio last year, a little bit earlier. Said it's going to break down, and it was around 2 and change, and now it's 1.37 ounces of gold per one S&P 500. Right. That broke down. It's already moved. That trade's happened, but to me, this is the next big trade.
I love this. Okay.
I want to put up something from Remo, Jimmy, if you let me, and we could go down the list. I don't really trade this way, but the question is, what is your portfolio percentage weight? Equities, gold, oil, bonds, crypto, et cetera, going into the midterms. I'll say right there is that going into the midterms, I would probably be light on equities in my speculative account and heavy on gold personally.
So I've been working for a year and a half on the boomer portfolio now that I'm above 60 years old. And here's what I'm angling for, Remo, is 40% in equities, 15% just, and again, there's another account that I have individual stocks in, but for my long term, 15% of the total amount of S&P, 15% in NASDAQ, 10% in a heavily hedged call strategy like TSPY. Then the other 4 buckets of 15% each in bonds like AGG, SGov, short-term cash, gold, silver, and real estate. Gold, silver in one of the 15% buckets, and real estate, with ETFs. And then I have like a dynamic options hedging strategy that takes advantage of a little bit of theta. Like every month I buy the 3-month outputs and sell the 2-month outputs to create the spread, and then roll that every month into those same durations. I just confused the shit out of everybody listening. Did I not, or no?
No,
so anyway, Mike gets it.
That sounded pretty diversified. I have to give an admission is last year was the first year since I started in the trading pits in '88 that I did not do a trade. It was a shocker. I mean, just imagine you not doing a trade the whole year. I just came in the year overweight gold and overweight treasuries, and now all I have is treasuries and just sitting back and willing to lose money because there's certain times you got to go with the gut and what you feel. And I just, like I said, when I show, treasuries the lowest since gold since 1982. Yeah, maybe it goes lower, but man, when that reverts, it's going to be a massive trade, and it's probably going to start when you at least expect it.
By the way, Mike, are you in like better physical condition than you've been in before? That you look really good right now.
I'm lucky. It's my firm let me move to Miami, and instead of taking a drive and subway in New York, I ride a bike to work.
Yeah,
so
you look fantastic. Yeah.
Well, you do, but it's the lifestyle here. Just I have to ride a bike to work. Sometimes the weather's not so great, but keeps me in shape. It forces me to stay in shape.
That's outstanding, Bobby. Yeah.
So let's move into a broader market conversation than we've been having. The economy itself, with the Atlanta Fed GDP now over 4%. Obviously, there's still a lot of inputs that have to go in there. What in that do you believe? Do you believe we're going to have a real GDP number at about 4% or more? Yeah, I just saw Nouriel Roubini. I think it was on Bloomberg today. It might not have been, so I don't want to talk too much about it. But it was basically, they said they went from Dr. Doom to Mr. Bullish or something, because he talked about the U.S. is now in a position to actually grow, which he never believed we could grow any more than 2% on average. So again, GDP sitting around 4.2%. What do you think of that number?
That is awesome. It's a wonderful thing. It's also, when you put it in comparison to our economy at $30 trillion, those are big numbers.
Yeah.
It's a sustainability thing. The bottom line is, unfortunately, it typically means inflation. And for Mr. Trump, I think he's not understanding running it hot means incumbents are going to get hammered in the election. But that's a great number. The thing to remember, what's happening is we're in the middle of this paradigm shift to AI. It means we're cutting jobs, and it's a transition. Now, in the long term, it's all going to be great for everything, like the internet was. But how much of that is already priced in the stock market? Like I said, it's so expensive. But yeah, those numbers are great. Sustainability, but to me, the bottom line is when if we get the 10% correction, that's a severe deflationary forces. That's going to just create complete reverse wealth effect. And a lot of that's also driven by, almost all it's consumer sentiment. Just when the consumer sentiment can flip on a dime. I mean, it did on 9/11. I remember that was obviously quite the extreme event. But running it hot means you're not going to get elected. I don't think Trump seems to get that yet, because running it hot means inflation. That's the #1 issue for most of the constituents. Also,
do we think Besant doesn't get it though,
or
do we think he doesn't care as much about the midterms as Trump might?
Well, no, I think, but #1, he's a loyalist. I think he gets it, I think he's one of the people who finally tapped Mr. Trump on the shoulder. Hey, by the way, if you want to get elected, these crypto people don't get you a lot of money, and it's kind of the right thing because they invest in treasuries. That was a good pivot. Did not pick up on that right away, but that was a great pivot. Now, Trump can pivot. I mean, he has. But right now, the number one thing when you're a politician, the number one thing right now is to get elected. Having sat on these Republican town committee meetings for decades, that was in Connecticut. But that's the difference now. It's the oxymoron that running a hunt is not really good for election, because we're at that point. I think we've created so much liquidity, we've created so much wealth, we're up so much that inflation's sticky, and your average person who voted for him, who's not the rich, the top 10 percentile or investing, who own all this real estate and equities, are not really benefiting.
Bobby, was it in unfilteredinvestor.com that I did the analysis on wealth effect and estimates on spending it creates? I wish I had those numbers in front of me right now, but I do think that is an outsized part of this economic boom that we're seeing is a huge wealth effect part of it. And not just in equities, but in real estate. And yes, people do spend their real estate and do feel wealthy on real estate. So I think when that turns, I do think that you could be right that it's a huge deal. But Bobby, a question to you real quick. When you look at charts, because at the beginning of this year, I said Russell over NASDAQ, that's working pretty good. And I said crude, that's working pretty good. Mike doesn't like crude. What do your technicals say on crude now after today's slight strength?
Crude is not in a convincing pattern yet. It's just not. It is held up where it needs to hold up to continue higher. And I'm talking technically. Yeah. I will also say that a typical trigger that I follow based on percentage B Bollinger Band signals has a buy signal for today, but it already reached its targets. So the momentum to the upside is not there, but it has done what it needs to do to rally. I just don't know. If we get the 4.2% GDP and that's real, that shows demand. And that's why I slightly disagree with Mike on the midterms, because I think we're going into a period of potential economic strength. I think crude oil will say that. But Trump will not like crude oil at $70, $80 as much as the Permian may like it.
And Mike, you think that I think you said something very casually before that you think crude goes lower. Is that correct?
So since 2022, 3 years, almost 4 years now, when it went above 100, I called for crude to go back to 40, just like I'd call for Bitcoin to go back to 10. It's just the way the cycle works. Partly, let's remember what's happening to crude. It's massively oversupplied. The low has been near 40 since 3 times since 2008. It's 65 now. The average cost of production, the world's largest producer and net exporter now the U.S., is $55 a barrel. Typically, the rules of economics, you have to get below that average production cost to shut off those excess of supply and demand. What's happening right now is there's a geopolitical bid because there's a U.S. armada around Iran, a large oil producer and exporter, but their exports go to China. Once that's relieved, however it's relieved, what this is doing right now, it's allowing those producers in the Western Hemisphere, which has shifted to the price maker now. It used to be in the Middle East. Now the Western Hemisphere is a price maker. From Canada down to Argentina, Venezuela in the middle. We are the massive, this is where the supply is coming from. And demand's declining from China. So it's a classic bear market, I think. And last year's mean was 65. Right now we're 65. So I look at it as it's a bear market. 200 days moving average is rolling over. You look for these probably sell rallies, maybe between here and 70. But the point is, it's not me, it's the producers are selling. That's why you have backwardation. So for instance, the front contract 65. If you go out to Dees is running 63 or lower. All the forwards, the backs are lower because they're selling forward and bringing on the supply. It's rinse and repeat. If we're lucky, if we get a bounce, they're going to sell more and bring on more supply. But the key thing is the world has shifted. I fully still expect it to head towards 40. And by the way, I have a very motivated president, the world's largest energy producer and net exporter who wants it lower. He'll make it happen. And we saw a little bit of evidence. Venezuela, what he did in Venezuela was a shocker. I'm sure Mr. Putin's looking at it. Oh man, so I've been bogged down in this war for 4 years. The world hates me. I'm killing a lot of people, and Mr. Trump just took over a country like
with 30 people
in a couple days.
Yeah, with 30 guys, he took over a country.
Well, and massive technology and planning.
Yeah.
The people and the intelligence.
Wasn't there some sound thing that happened that kind of disabled everybody? So just an amazing story. Bobby, got any closing words or no?
I'm good, guys.
Mike, tell the people where they can find you.
On your show. Thank you. This is my favorite program to be on. I just feel like we're bantering in the pits. Oh, by the way, I got to sell 100 at the market.
I'll be right back.
And on your show, I'm on X at Mike McGlone 11, LinkedIn, Senior Commodity Strategist. And thanks for having me on, guys. I really appreciate it.
Mike, you're the best, man.
Yeah,
you
this
are.
has
Thank
been
you.
Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino. Thank you guys so much for watching this and all the input you guys give. It is amazing. I love the live element of this show. You guys are the best. Thank you for joining us.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.